This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
As I said it before, and I say again, although I'd be wrong to say it's every exam, it's almost every exam. Somewhere you'll be doing weighted average. It may be a very little one, not many marks. It may be a big one, more marks. Let me prove it to you. Here is a question from your examiner. 3 of you actually saw it before because, if you just look at it with me, before you read anything, look straight to requirements. Last time, there are 3 completely separate bits. And you didn't turn to it now, Inessa. But the reason I gave it you last time is last time I just had you do part C. Because part C asked you to work out and comment on 3 ratios: interest cover, financial gearing, earnings per share. I don't know if you remember. But last time we did go through standard financial ratios. And it took a few minutes to find the figures, but we did do it last time. And it was nothing to do with the other bits. All right? So you can have a go at home, Andre, but it was nothing to do with the other bits. But last time we couldn't do parts A and B because I said I can't do everything at once, you know? Well, forget part C today. And forget part B. Part B is a bit of discussion which I'm coming to, but again, I can't, you'll appreciate, do everything at once. But just look at part A, which was 9 marks. It says calculate the current weighted average cost of capital of Droxful. Well, I'm not going to spoil it, but if you have a look, from the top it says Droxful is a listed company that plans to spend 10 million expanding its business. It's been suggested that the money could be raised by issuing 9% loan notes. Well, they're thinking of raising more money, and that was relevant for part C. But part A says calculate the current weighted average cost of capital. So the fact that they're intending to issue some more debt for part A is irrelevant. Would you agree? You've got a balance sheet there, and if you look at it, this company's raising its long-term money in 3 ways. They've clearly got share capital. Yep. Ordinary shares, $1 each. Further down, they've got 10% loan notes. Hello? They've also got 9% preference shares. And I did mention last time, preference shares, the only relevance really is they pay fixed interest. A fixed dividend, I beg your pardon, fixed dividend. And the 9%, well, it's 9% of the nominal value. So these shares have a nominal value of $1. There'll be a fixed or a constant dividend of 9 cents a year. You with me? So with 3 sources, 2 types of shares and loan notes. The bit below you can read yourself, but it tells you the market values, it tells you growth rates, whatever. Can you have a read and can you have a go? Can you work out the cost of ordinary shares? It's the formula. Can you work out the cost of preference shares? Same formula. Can you work out the cost of the loan notes? Check as you go along. Again, then we don't waste time, because you understand me, you get one wrong, you get the whole thing wrong, yeah? So check as you go along. If you've got all 3, can you work out the weighted average cost of capital? Okay? Off you go. I think I'm right. Walking round, I think you'd all got the three individually. Am I right? Did I miss anybody? So equity 12.09. Equity, remember, is ordinary shares. So equity 12.09. Preference shares 11.81. Loan notes, the debt 6.37. The weighted average, well, I've shown my workings, so I shouldn't need talk, but check me. The total market values of the equity, the preference, the loan notes. Once you've got the market values, then I'm not going to waste time there. Any mistake there is just careless. I think you're all happy with the idea, but is everybody happy with those market values? And I think my arithmetic's right. 11.06%. Okay? All right, there's bits of rounding. I think he got 11.05%. He's wrong, I'm right. But irrelevant anyway. I don't know. I don't think that was too bad for 9 marks. Particularly, obviously, when you've practiced a few. I said before, you've got to make sure internal rate of return gets quick. You know, it's always the same. So it's just speed. The other two are really easy. I know it takes a few minutes, obviously, here to find the information. And all right, in the middle of an exam, it takes a few minutes longer when your head's doing funny things. But even taking that into account, I don't think that's too bad for 9 marks. But, you know, that's your exam, you know, that's the level of difficulty. All right? Are we clear? Be honest, everybody. All right, I'm not going to give you more now. I'll tell you later. There are a few little ones at the back to practice on. But, yeah, well, you're all clear what we're doing, and I say that is exam level. But I now need to have a bit of a talk. Now, I'll try not to talk too long because everybody goes to sleep when I speak. But a few things here that are terribly, terribly important. If you just look at that on the screen, use any example, but this is as good as any. Ordinary shares, the cost of equity is 12.09. The loan notes, the borrowing, is only costing 6.37. Now, clearly, in the exam, you don't, for this sort of question, you don't bother thinking. You just get the numbers, outcomes, and answer, end of story. But, will somebody tell me, why would you normally expect the cost of equity to be higher than the cost of debt? I'd be very, very surprised if it was the other way around. In the exam, you do what you're told. But I would expect the cost of debt, here 6%, I would expect it to be lower than the cost of equity, here 12%. There are 2 reasons. Anybody, either of them. One reason is very obvious indeed. Why would you expect the cost of debt borrowing to be lower than the cost of equity borrowing? Don't be shy, I won't laugh. Forget the exact numbers here. I don't care the exact numbers. But in any question I ever did, although you'll do whatever numbers come out, obviously, I would always expect the cost of debt borrowing to be lower than the cost of equity. Why? Well, I know it may have been a long week for you. I'm sure you were all very, very busy Monday, Tuesday, Wednesday, and that's why you're asleep. The more obvious reason, surely, is on debt. Debt interest gets tax relief, dividends don't. Surely, that alone would make you expect the cost of debt to be lower Because you're getting tax relief on it. If there weren't tax, the cost of debt would be higher. Would you agree? Because of tax, it makes debt cheaper. Share borrowing doesn't get tax relief. There is one reason. And although it's somewhere in the notes, I would write it down because of what's coming. You would expect cost of debt to be lower than cost of equity. As I say, for two reasons. One reason is debt interest gets tax relief. Dividends do not. Now come on, if you are asleep, wake up. If you don't agree with me, shout and I'll argue. But on that alone, I would expect debt borrowing to be cheaper. Peter, would you agree with me? Don't just be polite. Good. All right, though, the other reason is more important. Even if there was no tax relief, even if we didn't get tax relief on debt, I would still, in fact, expect the cost of debt to be lower than cost of equity. Now, of course, if you didn't get tax relief, the cost of debt would be higher. Do you all agree? I'm not going to waste time here. If we didn't get tax relief, imagine maybe the cost of debt, instead of being 6%, if there wasn't tax relief, maybe it was 9%. I'm inventing a figure. But even without the tax relief, I would still expect the cost of debt to be lower than the cost of equity. Has anybody thought of another reason? I won't wait 5 minutes this time. But can anyone think of why, again, you'd expect it to be less? Well, let me tell you why, and listen carefully, and I'll write it down after. The reason is this. Why is the company paying, why is the cost of equity 12? Surely, from what we did earlier, it's because the shareholders want 12. Do you agree? If they want 12, we pay 12. If there wasn't tax relief, and I said cost of debt was, let's say, 9, why would it be 9? Well, if there was no tax relief, if the investor wants 9, the company pays 9. True? Well, we say the return investors require depends on how risky they regard the investment. If you're investing money, the more risky the investment, I think sensibly, the higher the return you'll want. Would you agree? And what we always, I mentioned last time, always what we mean by risk is how certain your returns are. That if you're investing somewhere, if your return each year was guaranteed, if it was fixed, we'd say there was no risk at all. However, the more the return you're going to get fluctuates, the more risky. And the point is, surely, if you invest in loan notes, your receipt each year is virtually guaranteed. I've walked away with these 9% loan notes, I can't remember. 10%. Surely, you're going to get fixed interest each year. Do you agree? It's certain. The only sense in which there is a risk is, of course, if the company goes bankrupt, you won't get your interest. We ignore the risk of bankruptcy. If we forget bankruptcy, your return each year, the receipt each year, in loan notes, is fixed. True? We say there's no risk. It's guaranteed. But, of course, if you invest in shares, you might be expecting a dividend of whatever it was, 35 cents growing. You might expect it, but of course, you know very well that the dividend you get might turn out to be higher, it might turn out to be lower. And that's what we mean by risk. Obviously it might be higher, great. It might be lower, problem. You base values on the dividend you expect. But because the dividend isn't guaranteed each year, some years more, some years less. You understand me? There's risk. And so in that sense, it's more risky to invest in shares than in debt. And if it's more risky, we say, right, you want a higher return. All right? Now, I'm not going to keep repeating, but I have to stress one more time. When we talk about the risk, we're talking about the risk of the receipts. If the receipts each year are guaranteed, there is zero risk. The more they're likely to go up and down, the more the risk. Okay? And so if you understood me, surely investing in shares is more risky than investing in debt. Therefore, the investor will want a higher return. And if the investor wants a higher return, it's going to cost the company more. All right? And so why is debt cheaper? It's cheaper for two reasons. Even if there was no tax relief, you'd expect it to be cheaper. Because investors are happy with a lower return. And as I said, making up a figure, maybe if there's no tax relief, investors wanted 9%. Lower than a 12. Because of tax relief, it becomes cheaper still. I think that bit's fairly obvious. But you would expect debt to be cheaper than equity for those two reasons. Debt interest gets tax relief, dividends do not. The other reason, debt is less risky for investors. And therefore, the investors will require a lower return. I'm afraid that's not the end of my talk, but that on its own is critical. And I say, I'm going to give up looking at your faces because you're staring at me as though I'm a banana or something. I'm assuming you understand what I'm talking about, otherwise you must shout. But for both those reasons, again, in the exam you don't sit and argue. You know, in part A you do your numbers, I don't care what comes out. But I'd always be very surprised if it was the other way around. Certainly in real life, you'd always expect debt to be cheaper than equity. Okay? Out of interest, since this is here, look at preference. I wonder why preference is somewhere in between. Obviously, sorry, I should never say obviously, but I hope you would agree, preference is going to be higher than debt because dividends don't get tax relief again. So that always pulls debt cheaper. But I said before, even if there wasn't tax relief, perhaps debt wants 9 or something. Why is preference between the two? I'll tell you, I don't know how much you remember of law, and I doubt he'd ask about preference. But what makes preference less risky than ordinary is preference shares, again, get a fixed dividend. Was this 9%? So they get their 9% a year. Ordinary shares, whatever they might be expecting, they know it might be higher, might be lower. You would agree? So you'd expect preference to be lower than ordinary. Preference are probably going to be more expensive than debt if you ignore the tax. Because there is still a bit of risk. Preference shareholders get a fixed dividend provided there are profits, you know. If there's no profit left, there is that risk they might not get a dividend. Debt interest comes first. Do you understand me? They've got to pay the debt interest first. The debt is never completely risk-free because there is always a risk they can't pay the interest. But because debt interest comes first, preference shareholders, there's a little bit more risk because there's more chance there's not enough left. Do you see my point? Now, I doubt he does that, but it fits in with what I'm saying. But in theory, if you're guaranteed income, we say there's zero risk. The more it's likely to fluctuate, the more risky, the more return. Well, everything fits. You see my point? However, that leads on to the next bit. So I'm sorry, I'm going to have to keep talking. All of that we did was very interesting. And again, I may as well use these figures as an example. That's how the company is currently financed. They've got all this money, arithmetically 11%. I'm not going to waste time checking it. That was just a bit of arithmetic. But always, the money we've already raised will already have been invested. Won't it, Inessa? It'll already have been invested. And the reason we're interested in the cost of money always is maybe the company's thinking of raising another $1 million in order to invest in new projects. All right? And if I were to tell you, I'm using this as an example, we're not going to do numbers, it's talk. If I said to you, look, that company currently has raised, 29 million? These were thousands. They've raised 29 million. Well, that's all invested. If I told you this company wants to raise another $1 million, then of course they have a decision to make. They could raise it by issuing shares. They could raise it by issuing debt. I think you'd agree. The company sensibly would want to raise it in the cheapest way. Would you agree? So how should this company, if they wanted to raise $1 million, how should they raise it? The obvious thing to say is, obviously raise it from debt. It's only going to cost 6%. Yeah? Certainly they want to raise it in the cheapest way. However, there is a problem. If this company was going to raise, let's make it more extreme, so they're going to raise another 5 million. You all see why, at a glance, it would seem obvious. The cheapest way is to raise debt. It's only 6%. Yeah? The problem is this. If they did raise another 5 million from debt, maybe the interest does cost 6%. Fine. Shareholders are currently happy with 6% after tax. Borrow some more? Fine. 6% after tax. However, if we did raise 5 million more debt, I chatted for quite a while last time. The more debt there is in a company, the more risky it becomes for the shareholders. You weren't here, Andrew, but I think you'll accept that. I went through that chapter explaining why it made it more risky. But the more debt there is in the company, because of the fixed interest that needs paying, there's more risk for the shareholders. And the problem then is, I raise the money, I'm paying 6% directly, but if shareholders see there's more risk, I'm going to have to pay them a higher dividend. Surely. At the moment they're happy with 12%, but if their shares become more risky, they might say, right, we want 15%. I'm making sense, I hope. And if they want 15%, I'm going to have to pay a higher dividend. Because if I don't, the share price will fall. Shareholders are going to be pretty pissed off. Yeah? And so, how much effectively would it end up costing me to raise this 5 million? It's not simply going to be the 6% we're paying in interest, but I'd have to take into account the extra cost of the extra dividend. And it could, in fact, get really messy. It could be, I might have to say, it's 6% to them, but then, maybe an extra 3% to keep the shareholders happy. I think you see what I'm getting at. Now, you'll never be asked to calculate that. You know, in total, how much is it costing? But what you will be asked about is that problem, that it's not so simple as, oh, raise loan notes, it's the cheapest. Raise loan notes, the overall cost, have I made it clear, will be more than 6. I could raise equity. Okay, if you raise equity, it looks terribly expensive at 12. But of course, the opposite of what I just said. If you raise more ordinary shares, the level of gearing is lower. It makes it less risky for shareholders. And they might accept less than 12. And again, although you wouldn't be asked to calculate the figure, if I say, what's the cheapest way of raising money? You can't just automatically say, oh, it's loan notes, 6. You know. It's a combination of, you know, you'd have to look at the overall effect. I hope you're clear what I'm trying to say. Well, although you won't get numbers on this bit of it, you will be asked to talk about it. And 2 gentlemen, a Mr. Modigliani and a Mr. Miller, in the 1960s did a lot of work on this, looking at the effect, be patient, looking at the effect of changing the gearing of the company. And trying to work out in theory what would happen. Because they said, all right, if you raise debt, it does make things more risky for shareholders, you know. But they said we should, in theory, be able to measure the risk. We know what's causing the risk. You know, it's not some dreamy thing. The risk is because we're having to pay out more interest. So they're saying we should be able to measure the risk. And in theory, we should be able to work out exactly how it would affect the shareholders. And we should be able to work out which is the cheapest and so on. You know? Now, there's a lot of theory, and they came up with some wonderful formulae, which aren't in your syllabus. Then the formulae, the numbers, aren't examined until paper P4, which is a choice paper. But you are expected to know not any formulae, but the conclusions they came to, which were quite interesting. Which I've got to go through. The effect that there'll be, they actually looked at the effect there'd be on the weighted average cost of capital of raising more debt or raising more equity, you know, the overall effect.